Hello everyone. So in today's video we're going to be discussing two concepts in regards to financial markets. That is, we'll first understand the difference between the primary and the secondary capital market, and then we'll talk about the first capital market instrument, which is shares. Specifically, we'll understand the difference between the equity and preference type of shares, which are the two most common types of shares which companies issue. So let's start with the first topic and understand what is the difference between the primary and the secondary capital market. So the primary capital market is basically the market which allows companies or the governments to raise money directly from investors. So let's take an example. Let's say there is a company ABC which wants to raise 1 lakh rupees from investors, and this company goes in for an IPO where it issues 100 shares, and then you have investors who end up buying these 100 shares. So this process where the company which wants to raise 1 lakh rupees issues new shares and raises money from investors, this process takes place in the primary market. So the primary market is the market which is allowing an interaction between the entity which wants to raise funds, in this case the company, and an investor, and it allows the company to raise money directly from the investors. Also in the primary market, the money which is getting raised from investors directly goes to the company. Now once the company has raised money from investors and the investors now hold the shares, if the investors, let's say, want to sell the share to someone in the future, they will be doing that in the secondary market. So let's say there is an investor who owns 10 shares of this company ABC, and let's say 1 year down the line, after having purchased these shares in an IPO, if he wishes to sell these shares, he will be selling these shares through the stock exchanges such as the National Stock Exchange or the Bombay Stock Exchange. So the process where investors sell the shares after they have purchased these shares from the companies happens in the secondary market. So the secondary market is the market which allows investors to buy and sell shares after they have been issued by the company. Now in the secondary market, the money moves between investors, so there is no involvement of the company. So there is no involvement of the company when it comes to the secondary market. Now because the primary market allows direct fundraising by companies from investors, it enables companies to raise funds for different objectives such as business expansion, or it could even be for loan repayment and multiple other objectives. On the other hand, the secondary market allows investors to exit their positions. That is, the secondary market allows investors to sell the shares which they have and convert that share into cash if they decide to do so. Now if you talk about the prices in the primary market, the prices are determined based on the price at which the company wants to issue the shares in the market, which is generally fixed, or it is decided via book building process. So companies, as we've discussed in the last video, rope in services of investment banks or merchant banks, and through the process of book building, companies decide on a price band at which they want to issue shares to investors through an IPO. So the prices out here in the primary market are determined either by the company or the company with the involvement of merchant and investment banks. On the other hand, if you talk about the secondary market, the prices of shares of a particular company depend on the demand as well as the supply of those shares in the market. So let's say if the company has very high growth prospects and the company is extremely profitable, so the company's shares are going to be in high demand. So there is a good chance that the share price of the company might be significantly higher than the price at which that share was purchased by an investor through an IPO. So in the secondary market, the prices are determined based on demand and supply. So this was the key difference between the primary and the secondary market. Now let's move on to the second topic for today, which is let us understand the first capital market instrument, which is shares. So shares are basically units of ownership in a company. Let's use a simple example to understand this better. Let's say again there is a company ABC which has a total value of 1 lakh rupee. Now let's say this company decides to divide itself into 100 shares of equal value. So the value of each share is going to be 1000 rupees per share. So if any investor, let's say any investor A buys 10 shares, so this investor will become a 10% owner in the company. So basically shares are those units which allow investors to invest and become partial owner in the company in which they are investing. Now companies tend to prefer shares as a mechanism of raising funds because the money which the companies raise from investors via shares, they are not obligated to pay back that money. On the other hand, let's say if a company is raising money from investors via bonds, then the company is obligated to pay back interest as well as the principal or the original amount which the company had borrowed. On the other hand, if any funds are being raised by companies via shares, they are not obligated to pay back that money to the investors. Now if you talk about the share price, we talked about just some time back. So the share price of any company depends on several factors, and some of those are the demand and supply of those shares in the market, which is again influenced by factors such as how is the company performing, how is the profitability of the company, what are the future growth prospects of the company, how is the overall economy doing. So the share prices tend to fluctuate and depend on multiple factors. Now any investor which invests in a share of a company generates returns via two broad mechanisms. So the first mechanism through which an investor earns in shares is dividends. So dividends are basically mechanisms through which companies share a portion of their profits with shareholders, and companies share dividends because companies treat dividends as a reward to shareholders for becoming partial owner in the company. So basically dividends are the distribution of some of the profits which companies do with shareholders as reward for investing and becoming shareholder in the company. So that's the first mechanism through which an investor generates returns by investing in a company. The second mechanism through which investors generate returns by investing in a company is via capital gains. So let's say an investor bought a share of a company for ₹100, and 1 year down the line the share value, because the share was in high demand, is 150. So if an investor decides to sell that share in the market for 150, he will generate a profit of ₹50. So that is the second way an investor can generate return by investing in a share. Now if you talk about your shares, the two most common types of shares which companies issue are equity shares and then you have preference shares. Now we'll understand what are the key differences between these two types of shares. So if you talk about your equity shares specifically, so if someone says, let's say they've bought 100 shares of HDFC, in most situations they refer to equity shares. So equity shares are the most common types of shares which are generally issued by companies. And if you take the example we've discussed right now, any investor in an equity share becomes a partial owner depending on how much of the company's total share he's bought. So like an earlier example which we took, if there are 100 shares and the company is worth 100 shares, So if someone buys 10 shares, he becomes a 10% owner in the company. And like we've discussed right now, equity shareholders generate returns via two broad mechanisms. That is, they get dividend payments, which is a portion of the profits which is distributed to shareholders, and then they also earn returns via capital gains. Now, if you talk about equity shareholders, holders of equity shares carry three types of risks. So the first risk is that the company is not obligated to pay any dividend. So let's say there is a company which made a profit of 10 crores. So the company could decide to distribute 2 crores as dividends, or the company could be like, we want to reinvest the entire 10 crores back into the company for future business expansion, and the company may not decide to pay any dividend. So basically the company is not obligated to pay any dividend, and that is the risk which any equity shareholder carries. That is, he may not generate returns via dividend if the company decides to. And the second risk is that the share price may fall. Now, while we said that earlier, if the share was issued at 100 and it became 150, so there was a capital gain of 50. Now, there is a very good chance that the company was not profitable and its demand for the company's share decreased. So, a share which had an original value of 100 could have a value of 70. So, if someone, let's say, was in need of urgent cash, so that investor, if he wanted to sell the share, he would incur a loss of rupee 30. So that is the second risk which any investor in equity share carries. That is, the share price may fall and he may suffer a capital loss instead of a capital gain if he wants to sell that share for cash. The third risk is that if a company, let's say, which has issued shares becomes bankrupt and its assets are sold so that different investors can be paid some money which they've invested in the company, in that situation also equity shareholders are the last set of shareholders which are paid. So they are the residual claimants in case of liquidation of a company. So there is a very good chance that once a company is liquidated, they might not get paid if there are no funds remaining after all the other creditors and investors in the company have been paid. So that is the third risk which equity shareholders carry. However, now because equity shareholders are considered as real owners of the company, they get important rights as well. That is, they can vote on key decisions of the company. So for example, if the company has to elect a new member of board of directors, that is something which the company needs to get voted and approved by equity shareholders. Secondly, let's say if the company wants to acquire another company, that is also another decision on which equity shareholders get the right to vote and decide. So this was the concept of equity shares. Now let us understand preference shares and how it differs from equity shares. So if you talk about preference shares, preference shareholders are given preference over equity shareholders in regards to two things. So the first thing in which preference shareholders are given preference over equity shareholders is distribution of dividends. So if a company decides to give dividends, in that case preference shareholders are given dividends first, and only after that equity shareholders are given dividend. Also, another thing to bear in mind is that preference shareholders generally have a fixed rate of dividend. The second thing which preference shareholders are given preference over equity shareholders is that they have rights of precedence in case of company gets liquidated during a bankruptcy. That is, if a company gets liquidated during a bankruptcy and its assets are sold to pay investors, in that case preference shareholders are paid before the equity shareholders are paid. So in regards to rights of companies' assets also, preference shareholders have a greater precedence over the equity shareholders. So if you talk about preference shares, they are in a way like a hybrid type of instruments. Why they are a hybrid type of instruments? Because they seem to be combining features of both debt and equity instruments. So if you talk about the feature of debt instruments which preference shares combine, is that they tend to pay a fixed dividend. So like your other debt instruments, for example bonds, which pay a standard interest rate and then they repay back the principal amount on maturity. So similar to that, preference shares also have a feature of debt instrument, that is they tend to pay a fixed dividend to the investor. On the other hand, they carry features of equity because they are a type of share and they provide a form of ownership to the investor. However, there is a difference between preference and equity shares, which is that preference shareholders have limited voting rights. That is, unlike your equity shareholders, they cannot vote on day-to-day matters. So, for example, if a director needs to be selected or appointed for a company, then preference shareholders cannot vote on this matter. However, preference shareholders are entitled to vote on matters which directly affect their rights. So let's say the company, while issuing preference shares, announced a dividend of 8% per annum. However, if the company, let's say, wants to reduce that to 5%, now because this is a right which directly affects the preference shareholders, so on this matter preference shareholders have the right to vote. So overall, preference shareholders are those instruments which would be preferred by a specific type of investors. So the type of investors which want fixed dividends as well as capital safety, that is they want some amount of money in case of bankruptcy and liquidation. So in those matters, preference shareholders or preference shares are the type of shares which will be preferred by investors. So this is all we wanted to discuss in today's video. In next video, we're going to start with an understanding of what are debentures. So stay tuned and follow for more concepts in regards to UPSC economics. Thank you so much for watching.